football, the red zone is where a team has to make small adjustments to ensure victory. As you approach retirement, you also need to make small adjustments to ensure success. This is the Red Zone Retirement Program with registered investment advisor and enrolled agent John Mears of Mears Money Management.
All right, Coach, we're back for another edition here. So let's talk about the market, because we're taping this on Monday, April the 7th. There's not a lot happened today, I don't think, right? You know, so
nothing's happening at all.
Big.
Just up and down and up and down.
Yeah, exactly. So you and I are going to talk about what should we actually do when the market drops, right? So we kind of put this together really quick. We realize people are, we're taping it again on Monday the 7th. You may not see it until a couple of days later or whatever. So things are probably going to change. But I think overall, we just kind of want to share some things to think about, right?
Yes.
So are you getting bombarded? Because it's been dropping Thursday, Friday, it dropped, right? Everybody panicking, everybody calm. What's going on?
For the most part, I think my clients, we do focus on educating the clients.
Sure.
And so I actually have not gotten really more than one or two phone calls. They aren't even panicky. They're concerned, I guess is the proper way to put it. But
Totally
that's fair enough. And then I also proactively try to get stuff out to people just to kind of let them know, either a video or an email sent out on Friday saying, hey, this stuff happens. This is, and it's not just now. A lot of these occurrences in the markets are due to politicians. Believe it or not, they are.
Sure.
So if you go back to 2008, 2009, whether you want to put the blame on big banks being greedy or
Freddie
the fact
Mac
that
and Fannie Mae and
allowing this to happen. We look at 2000 during the pandemic, we were doing lockdowns. 2002 interest rates. You kind of get the vibe here.
Yeah, 2022. Yeah.
A lot of these are self-inflicted wounds, if you will.
Yeah.
Again, the pandemic wasn't, but we kind of reacted, in a certain way, which may have caused market jitters. And so, in my lifetime, the only time I can see a true market reaction was back during the dot-com bubble, and that was 2001, 2002. And to be fair, that was actually after 9/11. So these things have all occurred due to things happening, and stuff happens all the time. All the time things happen. And so we need to be prepared. Our portfolios are designed for all weather, whether the markets are up or the markets are down. We are prepared for that. So.
Yeah. Well, Coach, I mean, obviously what's happening is global, right? So this morning, again, I'm going to keep kind of giving context here that, we're taping this at the middle of the day on April the 7th, at least middle of the day, my time. And, so it's, over the week or last night, China was down. Every country's market is down at the time this morning. When we first woke up and we're looking at stuff, every single thing is down. Now, since then, we've been up and we've been back down and we've been back up again. Right. And it looks as though a number of countries are coming to the table. What they're trying to do, this administration is trying to do is pretty groundbreaking. I mean, it's never been done. So there's going to be some pain. I think the theory is hopefully that, the concept is going to be short-term pain, long-term gain. That's what we all hope for, right? So if you are panicking, let's just start with, I guess, gut check, right? As a coach, same thing, right? You dig deep, guys. You're getting your butt handed to you in the game. Time to gut check, right?
Yeah. It's something that you need to. There is psychology involved in investing. We all think it's just about numbers, but it is about psychology. And I always tell people the market dropping isn't the problem. Your panic is the problem.
Yeah, if you start panic selling, Coach, you're locking this in. That's the worst thing to do.
Yes. And I tell people historically, this is just going back for the last 100 plus years. 1 out of every 4 years, the market's going to be down. 3 out of 4 years, it's going to be up. When it's up, it averages. We're talking about the equities portion of your portfolio.
Okay.
When it's up about 21%. When it's down around 13%. So you're going to do. So once every 4 years, the market's going to go down. It's going to go down by more than 10%. So that's something that's going to happen. And you have to be prepared for how you're going to deal with that and understand that you're being rewarded for going through this. Sure. It's like the kind of a hazing, if you will. This is something you're kind of being forced to go through this, see how you react. If you react calm, cool, and collected, you get rewarded. If you overreact and you panic, then you are not rewarded. And that's really the simplicity of what happens with volatility and the reason why you are getting rewarded, because there is risk in equities. There is. Risk is going when the markets are going up and down. So you're getting rewarded for that risk.
if you're getting a gut check, have you talked with your advisor recently, or have you been kind of just enjoying the fact that, the last 2 years, for example, it ended 22% up, right? So do you just have you just been riding the status quo instead of being proactive? And by the way, if you are, if you've not talked to your advisor, if you've not made any changes, if you've not gone through and said, hey, do we have a strong plan, or do we need to peel back some of the, some of the winnings, take some stuff off the table? Then you have that self-inflicted wound, coach, that you were talking about, because this administration has been saying they were going to do this for the last year and a half. So it's not like it's news. Now, maybe the reaction by other countries is a little different than expected, but still, it's not news.
That is correct, and there's a couple of things based on what you just said that go into how we do our financial plans too, and that is we will rebalance. Now, so far year to date, this is something that I was trying to explain to people last week when I was trying to be proactive with people.
Okay.
At the end of last week, everybody was kind of running for the hills thinking it's all going to hell in a handbasket.
Right.
And the fact of the matter is my moderate clients were down about 2% year to date. That's not bad considering that the markets, the S&P and the U.S. markets were down.
That's
but again,
great.
We're not just in U.S. markets. We have
that's a great point. Coach, that's a great point.
Not.
So over 5 days, if I hit the S&P 500 right now while we're talking, over 5 days, it's down 11%. Over 1 month, it's down 13%. But you're only going to be down 13 if you're 100% in that, correct?
That is correct.
Okay.
So bonds are still up. Bonds are hanging in there. What's happening is the interest rates go down, bond prices go up. And then there's a couple of international ETFs that we use that are up. And actually, there is an international value fund that's up nicely actually right now. So this is people get tired of us talking about diversification. But this is why we do
this
it.
Is totally
this is why now. Not when we're all having a great time and the drinks are on the house kind of thing. This is when things are getting a little scary for some of you out there. This is why we diversify. And I tell people all the time in retirement, our goal is not the highest yield. Our goal in retirement is risk mitigation. Risk, we want to stay on top of risk in retirement, which means we want to be in a steady area. We want to have that lane, which is never too high. And in instances like this, never too low.
And Coach, it's tough, right? Because let's be honest, the media mainstream media is going to run with every negative thing they can run with, which just adds to the possible panic and fear. That's their job. I mean, it's unfortunate that that's become their job, but that's what they do, right? We all know it. That's what they do. And so they're not going to really look at there's potential negatives to this. This could blow up in the administration's face. It also could go exactly like they think. And it rebalances trade across the globe and things get a little more fair. And we get, hopefully, again, short-term pain, long-term gain. But let me give you this example. Okay, so the Kramer was saying leading into today that expect a Black Monday style drop today. Right? So that was 20, I don't have the exact numbers, 23%, I think, roughly in 1987. I think it was in a single day, it was 23%.
In 1 day, yes.
In 1 day. But most people don't bother to take a look at because that's sensational, right? That's all that gets talked about here 40 years later, is that it recovered by the end of the year.
Mm-hmm. Yes.
And that was in October that happened, by the way, right? So it recovered, 2 months later? So same thing with COVID. You mentioned that, right? It was down, it was back up a month later. 9/11, it was down, it was back up 31 days later. So I think that's the hope, right? Is that this is a negotiating tactic that is short-term pain, for long-term gain. Is that fair?
Yeah, and it's funny. I'm a big believer in free speech. If you want to protest, you have all the right in the world to protest.
Yep.
But what I do find amusing is sometimes I see people that are trying to explain why they're protesting the tariffs. They don't really understand what they are. Now, again, I'm not trying to defend tariffs at all here. I'm just saying that people don't know what they're arguing about. I had a whole podcast on this. Would we do this 2 months ago on tariffs?
Yeah, something like that. Yeah.
And we could probably put a link to that here where we kind of explain the pros and cons. There's possibly some good things. If they don't do it right, then it can be negative. So
absolutely,
they're walking a fine line here. Let's not make any mistake about that.
For sure.
They believe they have an end plan. And at some point, if they have an end plan, it's like, I'm going to use my football analogies like I always do. We have a 10-game season. We may first game or two, we may not win those first two games because we're trying to develop the game plan, trying to figure out how to run the ball and trying to play good defense. And sometimes it's not pretty, but if you keep doing the right stuff, blocking and tackling, making sure you run the ball, you get better at it, and then you have a successful season. That's kind of what I see us going through right now, possibly. Right. If we're going to give any credit to the administration, that they're trying to establish the ground game right now a little bit, try and get this going.
Yeah, and it's also something that hasn't really ever been done, or at least been done at this level in a very long time. So it is going to cause some reaction for sure.
Yeah, and we can't compare this back to 1930. I know a lot of people have been saying that this is what we did in 1930, but the global markets are totally so it's just a completely different world that we live in right now. But, so it's interesting to see. We should not be panicking over this. One thing that we need to go to discuss with our clients is how what is your risk tolerance, and I think that's something that people are liars out there. They just are, not intentionally, but they are liars because
we kid ourselves, we fool ourselves. Yeah,
yeah, they like volatility when it's going up.
Sure, yeah.
They don't like volatility when it's going down.
Yeah, and
so this is why we need to discuss with people in instances like this. What is your downside tolerance? Now, I don't agree with how we do these risk tolerance questionnaires where you give 3 scenarios and how you're going to react, because we don't know how you're going to react. Right. Until it's actually happening, or, we can always use the Mike Tyson phrase here. You never know what your risk tolerance is until you've been punched in the face. Well, this is where we have to really talk to our clients, and clients, you need to talk to your advisor about, what is your, are you really truly risk averse? Some people can't handle this, by the way. There are people out there that, it doesn't bother me. I know it always comes back. I have people like that haven't even blinked an eye. I think most clients that are
based on the fact you only had like 2 or 3 upset calls, or not even really that upset. That's good.
Yes. So my clients tend to lean conservative, even here in California. That doesn't mean they're all conservative, but the ones that are conservative may not be all in on what's happening, but they're at least willing to see how it plays out a little bit. So that's kind of the reaction. So from a risk standpoint, they're not yet at the panic point, but they are probably kind of going, let's watch it. Let's see how it goes. And we're hoping he's right.
Yeah.
And there's a few that just believe they're all in on the tariffs. They believe it's the best thing that could happen. And
you should never be all one way or another, right? Because that just gets you into bad shape. Well, actually, because that actually brings me to a great point. I want to finish with this kind of final thought, right? So unhelpful behaviors, Coach. What do I need to stop doing right now, right? So the immediate reaction is people say, I need to stop being in the market, right? That's probably the worst thing you can do. Give us 3 bullet points of like things that are just not helpful behaviors.
So the one thing that we're all victims of this. We have all done this, and we call it doom scrolling, where you're just going through.
Yes.
I absolutely have done this. Absolutely guilty as charged, where you're going through, and then you have your own lens that you're looking at life through, and you know how the algorithms work.
Yep.
You get more and more of that.
You get more of it. Yeah.
If you're on Facebook or Twitter or whatever you're looking at, stop. Stop. There's a point where you may want to check a couple things, something that kind of catches your eye, but don't do your doom scrolling. And one thing also, don't make permanent decisions based on temporary fear. This is a big thing here. You can make a knee-jerk decision, which will affect you for a long time. Now, my clients, again, we talked about rebalancing a few minutes ago. When the markets are down, that's a great time to buy. We know that.
Yes,
in
sir.
fact, I've had a couple people already get a hold of me saying, should I send some money in?
I want to buy on the dip. Right.
Yep. Great time to buy. And that's what we do naturally through rebalancing. Again, bonds are up, skims from the profits of the bonds, buy some of the stuff that's down, even though it's counterintuitive to what most of you are thinking. But that's something to do, is to rebalance. So don't make long-term knee-jerk reactions that will have long-term results here. And then one thing you want to make sure is that you just remain disciplined here. That's one thing that you have to do, is just making sure. It's hard to do. I get it. I really do.
It is.
It's hard to do. But if you can maintain your discipline, that's still the most important thing to do. So,
I mean, think about weight loss or giving up alcohol or whatever. Discipline's tough for humans, right? I mean,
it is.
some people are great at it and some people, and a lot of us stink at it, or we all stink at it in certain categories, right?
Yes.
And so it's tough when you see in your money hop all around. I get that. But again, if you've got a strategy and a plan, especially for a lot of our viewers and listeners of the podcast and of the YouTube channel, hopefully this is still long-term money. I get that you're closer to retirement, but if this is not money that you are accessing this year, then the panic should not be as, I know it's tough. Like we just said, it's tough, but is that fair as well, Coach? Like, this is not money you're pulling out this year.
Yeah.
Try not to
So
panic.
I'll conclude with the one thing, and I harp on this on all I've said this so many times. We have, for our retirees, we use guardrails. We have an income strategy. We have it written down in black and white where that level is, where we need to make adjustments. My clients are not even anywhere close to that right now. But if the markets continue, we will be proactive with our clients and say, by the way, we hit this number. And if somehow I disappear into the abyss, my clients have it written down themselves where they know, okay, I need to make an adjustment, and then what that adjustment may be. So a lot of times if somebody's taking out $3,000 a month in distributions, that may mean reducing it down to $2,700 a month in distributions. It's usually very, very, very minimal adjustments that need to be made. And again, we have it in black and white. That's why my client base, I believe, has been pretty calm through all this. We have written this down in black and white. And if you're listening to this and your advisor's not doing that, that's probably something you may need to discuss with them. So it's
Great point.
It's important, I think, to have your game plan written down.
Well, if you need some help, we've got links in the show descriptions for you to reach out to John, get onto the calendar, have a conversation, and talk about what you've got going on, and hopefully maybe mitigate, making snap decisions that could cost yourself more issues. So again, find them online at bookachatwithjohn.net or go to mearsmoney.com. You don't have to remember those to pop up on the screen, or they're in the show links, the links in the show descriptions below. So go check those out. And don't forget to subscribe to us on Apple, Spotify, and of course, YouTube. Supports the channel, also helps you catch more content as it comes out. We do a couple of these a month, as well as the occasional different short content that Coach puts out to try to help you deal with this crazy stuff that is finance and economics and retirement. So we'll see you next time, Coach. Thanks for breaking it down. As always, appreciate you, my friend.
Yes, Mark. Thank you.
Thanks, buddy. We'll catch you later here on Red Zone Retirement Program, Simple Investing, Smart Future with John Mears. John has a couple of free books, Diffuse and Tax-Free Retirement in California, that reveal exactly how you can experience zero taxes in retirement and overcome the IRS lien on your 401k, IRA, and 403b, which could threaten your future lifestyle. These are complimentary, so all you have to do to pick these up 100% free is just stop by RescueMyRetirement.net. That's RescueMyRetirement.net. Fill in the basic info and he'll ship those out to you immediately. That's RescueMyRetirement.net for a copy of Diffuse and Tax-Free Retirement in California.
Advisory services offered through Mears Money Management, Inc., an RIA registered in the states of California and Texas. California Department of Insurance License number 0685203.